Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday, the 17th of June, 2022. As always, this is general commentary and doesn't take your personal situation into account. All right, well, today we're going to be covering the SP 500, the Australian ASX 200, and I've also got some fascinating sentiment graphs for you. And my favourite one is all about how consumer sentiment can be an excellent guide to future stock market returns. So make sure you stick around to see that one. All right, with that said, let's jump into our first chart. So what we have here, we've got the SP 500 on the screen. And wow, hasn't it been an extraordinary week in the market? I saw a stat this week, and actually today I was looking through some stuff this morning, and in 5 out of the last 7 days, more than 90% of S&P 500 stocks were down. Now, you might initially think, well, that's not surprising, the market's been falling. But what is surprising is that, according to the source, and this is a reliable source, there's no precedent for this in the S&P 500's history. So, look, that's I think that's a pretty astonishing sort of fact. And look, there's just no precedent for this. So it really has truly been an overwhelming display of selling. And ordinarily, like extremes like we've been seeing lead to turning points. But when something's unprecedented, we really shouldn't overestimate our ability to predict outcomes. I think the best we can do is to consider scenarios. And that's what we're going to do today. We're going to go over some scenarios about where the market could be going from here. And hopefully that helps at least provide some sort of framework to the huge amount of uncertainty we've been seeing through these last few weeks. So what I want to do, I want to start by talking about where I've been wrong. Where I've been wrong over the last 2 months. So in this period here, I want to tell you about where I've been wrong. And I think, look, my biggest error has been my optimism for larger bounces over the last say 6 to 8 weeks. So what I'd been saying in these videos, like I talked about the potential when we're around here. I thought that the rebound off this low was going to be a zigzag higher. I thought here we might have seen one more leg up. And then again, I made the same mistake through here. Talked about the potential for the rebound when we were near the lows, got the initial part of the rebound, and then I was as early as, as late as this point here, I was still thinking we could have seen another leg upwards. And then I've been talking about the potential for a retest and a break to new lows, maybe around August, September. But this has all been happening way quicker than I was anticipating. It's, look, as I was saying earlier, it's been an unprecedented, continuous bout of selling. COVID, of course, was a different story, but this has its own unique set of statistics. And so that's where I've been wrong. This selling pressure really has been relentless. Where I have been right, though, I guess, look, I think where I've been right is I've had these ongoing calls to play defense. I've been calling to take this defensive or this cautious stance since the Nasdaq broke down in late January. So it was really it's really through this period here where I shifted my game plan from playing the rising trend to playing a defensive game. And with the market below the moving averages, so we just put those moving averages on that I talk about each week, with the market being below this 50 and 100-day moving average, I've been saying, as you know by watching these videos, I've been talking about not buying the dip, and I've also been talking about selling the rallies. So using these rallies as an opportunity to clean up a portfolio and get rid of stocks which have been breaking lower. So while I've been wrong about the extent of the rallies, hopefully the overall defensive playbook has been helpful, and it's helping you get through what is really a diabolically awful period in the markets. So what now? Where do we go from here? Well, I'm going to start with a negative scenario. And it's going to sound pretty alarming, the scenario I'm going to outline. And I don't want to be an alarmist. There are so many alarmists talking about markets, and there always are. You know, I read about one guy during the week who's predicting this decline is going to be a 70% decline. The thing to add on to that, though, is he's been talking about this for the last at least the last 8 years since 2014. So, you know, call it every year. 1 year you might get it right, but it still could be decades away. So who knows? So I don't want to be an alarmist, but yeah, look, this is a confronting scenario. But look, I think it's a scenario we do have to consider given the setup which I'm seeing. So the SP500 and the NASDAQ, they're currently in what I call a waterfall or a cascading type setup. So let me draw in what I mean by that. So let me just get the right tools here on this chart. So a cascading type sell-up, I'll actually draw it in this way first, where the market, you know, declines. We get a decent rally. The next decline is a bit sharper. The rally's shorter. Then we get another sharp decline, an even shorter recovery, and then you get a significant downdraft. That's what we call it's what I call. It's not really a technical term, I don't think, but it's one which I've used over the years. It's a waterfall or a cascading type move. We're just drawing that in there. So it starts off routinely enough, but then it does crescendo into a sharp drop. And I've seen this pattern develop in many markets over the years, and not just in stock indices, but individual stocks, currencies, commodities, all sorts of markets. And sometimes I see this set up on hourly charts, sometimes it's on daily charts. You don't see it every day, but it is something which I've noticed quite a bit over the years. And as that cascading motion develops, the eagerness to sell intensifies until it gets to a point where the sellers just overwhelm the buyers, and that's where you get this rapid decline. Now, I'm going to show you a couple of examples from past markets. So here's one here, and this is interesting because this is the last really big 50% decline we had in markets. It was, you know, the GFC, and you've got this cascading motion where the market sold off. We had a multi-month bounce. And this is the sort of bounce I've been looking for through the recent decline, which we just haven't got. And the multi-month bounce, we had then a sharper decline. We had a shorter bounce, and then you had the cascade or waterfall sell. Another example, I went back to the early to mid 70s, and we've got a couple of examples here where, you know, decline, you know, the multi-month rally, declines intensify, the rallies get shorter, and then it's, you know, kaplunk, and down it goes. Same thing during this period here. You can see the selling then intensifies until you get it's really the capitulation of that final sell-off, which is the waterfall moment. And the one we've got, like this one here, this one went from 68 through to 1970, and then 73 through to 74. What we're getting here, it seems to be happening quicker. Doesn't mean it's going to happen by any stretch. It's just it's a setup and it's a scenario. And but look, it is one which is there. And I'm also looking at the volatility index, or the what we call the VIX. And let me just find it. Here it is here. This is also part of the puzzle. What we have here in the volatility index is the market. The volatility has been coiling. It's coiling motion, which we use that point there. So we've been coiling up in here. Only a week ago, I thought we were starting to break down and volatility was coming out, and that was going to help get that rebound, which I was incorrectly expecting. And instead, we've got another test up towards the top of this range in volatility. Now, if we just go back to a previous period, just back into into 2019, and we had the same sort of setup. So these setups never play out identically. They just give you guides as to, you know, the sort of thing that can happen. And we had volatility was contracting, and then we got this breakout, and we had the markets really fell heavily. It was the capitulation waterfall type sell-off in it was Christmas, around Christmas 2018. So you can just go back on the chart and find that yourself if you'd like. So yeah, wondering whether maybe that's going to happen here. Maybe it is a case that we do get a spike in volatility and the market does fall rapidly. It's one scenario. And just remember, this isn't a prediction. It's not a prediction by any stretch. I'm simply outlining a possibility to help better prepare you if it does happen. You'll have some sort of framework around what could be unfolding. So this is by no means a sure thing. This type of pattern which I've been talking about, it doesn't always play out by any stretch. But look, the setup is there and it's possible, and it's another reason why I don't want to be trying to forecast a bottom or forecast like a lasting low on this market. It's still vulnerable. Yeah, it's still a vulnerable market. Just putting those moving averages on, while the market is below its 50 and 100-day moving averages, it's still vulnerable. So my suggestion is to still consider playing defense. I don't think this is the time to go on the attack and say, okay, stocks are cheap, stocks are a bargain, I've got to start buying. People are doing that. Maybe it'll work out, but the downside, if they're wrong, is it's still potentially incredibly significant. Okay, so that said, that's a bearish case, which I think we need to be aware of. So let's consider some more optimistic developments which have been occurring over the last few weeks, which could point to a different outcome. So first of all, I saw an interesting graph through the week, came up on my Twitter feed. So this is showing the ratio of put to call premium. So the amount of money people the small traders are paying up to buy puts versus calls. And you can see, well, this is up top, we have the SP500, and down below we have this ratio. So when the ratio is low, it's these small traders are aggressively buying call options. So they're bullish the market. They're being aggressively bullish. And when it gets high, there's fear in the market, and they start buying a lot of puts as either speculation or as portfolio protection. Now, we've recently just come up here and hit this point here at 0.75, and the guys who put this on the Twitter feed, they've marked the last two times the market's got up to 0.75. This period here coincides with the low in 2002, which came after the dot-com bust and a recession in 2000. It was early. There was a little bit more time before the final low was in, but it was very close. It was very close to the final low. There wasn't that much more downside. It was just more time. Same thing occurred here. This was in 2009. This was near the GFC low. Again, we can see that this ratio was rising. Market bottomed. It was, look, I think it got within 10% of the low, and it was another 3 or 4 months, but it was close. Okay, the next time is now. This indicator triggered just in the last week. What does that mean? It doesn't discount the fact that there still couldn't be a capitulation sell-off, and then a low is, you'd say, well, the low occurred only a few weeks or a month or two later, so it would still be the same sort of signal as these previous ones. It doesn't tell us the market is at a bottom, just that we're getting into that period where you start saying, well, look, we're potentially getting close time-wise, maybe price-wise, but it's it's getting interesting. So we've got that. That's a potential positive. Now, the next one is, look, the next one's fascinating. I love this next chart. This is a graph from JP Morgan, which turned up on the Twitter feed. And this is terrific. This is what this is, it's showing the University of Michigan Consumer Sentiment Index, and it goes all the way back to 1971. So I love long-dated studies, long-dated graphs there that get some terrific data. And now what we have, it's and they've also marked out 12 significant peaks and troughs in the consumer sentiment index. So consumer sentiment, it's not stock market sentiment, it's general consumer sentiment. So a lot of these people aren't even invested in the stock market, it's consumer sentiment. And so let's go through. So okay, so there've been 12 signals from this, and the SP 500 returns. So down here, let's look at the troughs first. So look at this 1975 trough. They're saying 12 months later, the stock market, the S&P 500 was up 22%. At this trough in 1980, 12 months later, we're at 20%. 1990, the next 12 months, 29%. You can you can go through these. And here we are now. Now, is this the low? This is what we don't know. Is this going to be the low in consumer sentiment? At the moment, it's the fourth lowest point. It's the fourth lowest data point. But that's not to say that it can't become the lowest point. Maybe consumer sentiment is coming down here. What we do know is when consumer sentiment bottoms, it has led to strong stock market gains, but we don't know where the bottom is. We're in the range of where bottoms in consumer sentiment have occurred, but we don't know where the bottom is. We only know that in hindsight. But we do know when it does bottom out, historically, we've had some really strong returns. The average market return from these 8 significant troughs has been 24.9%. Interestingly, on the upside, you can just pause the video and go through them yourself, but the average has been 4.1%. So the idea being is that the best returns happen when the most people are pessimistic about the economy in general. So interesting to see how this one's going to play out. And but a lot of data there to have a look at. And just one more graph which turned up, which I thought was really interesting to look at. It's another long-dated one. This one goes back to 1950. So this is some great research, which is looking at what's called buying thrusts or market breadth. And what it does, so the dotted line, you can see this dotted line through here. This is when buying is 2.5 times more than selling over the period being measured. And that's all these little arrows you can see. They're marked these points here where buying has exceeded selling by 2.5 times. And what is interesting here is that a signal was triggered only it was 3 weeks ago on the 27th of May during that rally we had 3 weeks back. It was a buying thrust. It was the data's down here. I think it was 2.58 times. And what all the stats on these buying thrusts over the last I think there's 38 of them. 38 of them over the last 52 years. And actually it's 39. And of those 39, all but 2 have led to gains over the next 12 months. And the 2 which were negative were only down like 0.5% or something. So not very much at all. And the average gain from all of these buying thrust arrows was 20% over the next 12 months. Now, if you look closely at these, they don't pinpoint the low. So I can see this one just here in the mid 70s occurred a few months before a final low, and there was more selling. This point through here during the GFC, again, it was early, but it was close to a low. So it seems to be pretty good at getting that change in big investor sentiment where the buying does start to come in and stocks do start to being accumulated. And we've got one now. So look, it's just going to be interesting to see how that plays out. So look, we do have some positive things, there's an alarming type scenario to be aware of, but there are some positive things starting to occur as well. So it's really that cross current at the moment. We don't know where a low is going to be. There will be a low, There are some clues that there could be one coming up, but it doesn't discount there could be a capitulation style sell-off before that occurs. So, okay, now if you're getting value from this, you're getting value from the video, please hit that like button. Please hit the like button. Please leave a short comment. The comments are really important because it tells YouTube that people are engaging with the videos, and they're more likely to show other people. And also hit that subscribe button if you haven't already, because that's also really important, because then YouTube will put these videos out to a wider audience, and that really helps me so much. So please do that. Please do those things if you can spare a moment for that. And now if you haven't, also jump over to my Motion Trader website. So this is where I do all the stuff with the algorithms, and it's all about trend following techniques. I'm using trends and these trend following techniques to identify opportunities on the ASX, and then we're using the strategies to maximize gains, to manage risk. We're cutting losses. All the tried and tested and time tested trend following approach, and using the algorithms to cover a lot of ground. And yeah, maybe take out that 14-day trial, see what it's all about. Always also tell you about the process, and using what I know to help you to give you the same information. So do that. Come over, check it out if you'd like to do that. Now let's jump back to our charts, and what we're going to do now, we're going to go over to the ASX 200. So not a good week in the ASX 200. So it's continued to unravel since breaking down from this little wedging formation that we spoke about last week. And it's also broken through support. So we can just draw that on the chart here. So line that up. It looks like, yeah, support in through around there. So that's 6,930 to 6,730. You can see this support band picks up these highs, some lows there, some more lows through here. Now we've broken through. What's another interesting thing we can do? We can put the Fibonacci retracement levels on. Now, if you've been watching this for a while, you'll know that I believe that this correction we're having, it's a correction of this entire advance from the March 2020 low. So when we put that's important for working out where to draw your Fibonacci retracements from. You've got to work out what you're retracing. So I think we're retracing the entire advance. So let's just put those retracements on. And we can see the ASX 200 has come right down to the 38.2%, which is probably the minimum band you'd expect for a significant correction. And that's not to say it's going to stop here. It could come down lower. It could get down to the 50% or even lower. And these aren't magic numbers. They don't work every time and every correction, but they're good reference points to know that we have met sort of a minimum standard for a corrective period. And I think that, look, I think the big point to make is this market remains vulnerable whilst it's below these moving averages. There is scope to bounce, but while we're below the moving averages, it remains vulnerable. But it doesn't look as exposed to downside risk as the US indices do. And I think, look, overall, I think the Australian economy's exposure to commodities is a big plus. I think commodities remain generally in a holding pattern, and should we continue to be in this risk-off environment, which we're currently experiencing, I can't see commodities doing anything too exciting on the upside. If anything, they're giving ground, because at the moment it's about, with so much uncertainty, so much fear, it's pretty much sell everything. The only thing really going up at the moment is the US dollar. Even oil's come back in over the last few days. But I think the medium to longer term fundamentals for commodities I think they're excellent. And I think it's a case of waiting for the price action to tell us when to go and have a closer look. No, at the moment there's not a hurry. Let's wait for the price action to tell us when the time is right. And the ASX 200, it also didn't have the same overblown bull market through 2020 through to 2021 as the US market did. So that's also giving it some sort of that's also like helping on the downside now when we're seeing the US market really starting to unravel. And but the main vulnerabilities continue to be those growth stocks that ran hard over the last couple of years. And I'm also seeing some sizable falls in the retailers at the moment. So for example, like a stock like Harvey Norman, I was looking at earlier. My motion trader service came up with a short signal on that recently, and you can see why with the moving averages turning lower. Look, as I keep saying, I just want to keep hammering this message. You don't want to buy stocks when they're below the moving averages, because look at this. Like, this wasn't a buy the dip opportunity because the price action has just fallen away over the last week. It's the most dangerous time to buy a stock when it's in decline below these moving averages. And another retailer which is struggling at the moment is one called Premier Investments. So we could go through heaps of them. I'll just go through these two. And you can see the same story. The moving averages crossed way back here in February, and it's been in decline since then. There's been no reason to buy this stock, although heaps of people have been buying it. Someone's buying, but they're fighting the trend. The trend is down, and this is what the motion trader way is all about. It's about trend following. It's about buying into strength, buying as stocks are rising, buying as they're rising, and then using risk management to exit stocks when the trend changes. So you then you preserve much of the capital you make during this period, and you avoid giving it all back potentially giving it all back during this sort of period here. So I'm going to wrap it up with a word on leverage, because this is such an important concept, leverage, because it brings so many people unstuck. I want to show you this. This is the ProShares triple leverage, so get that, triple leveraged NASDAQ ETF, as if like NASDAQ on its own is not giving you enough risk. This is for triple leverage. And it's during the bull market, there are all these stories of these first-time investors making a killing in the market in this type of fund. And like, leverage is great when the market's going your way. When it's going your way, leverage is great. But when it turns, it can be an absolute disaster if you don't have risk management strategies. And this ETF, it's down. This is a 70% decline. So people using this to try and pick the low on this market, maybe they could have gotten in and out and made some money. But I think for the most part, people using this ETF over the last 6-7 months, I think it's probably been a disaster, and they've probably been hit quite hard. There's an old saying. There's an old saying. There are old traders and there are bold traders, but there are no old, bold traders. And I think that's just so true from all the people I've seen over the years. It's the people who take excessive risk that end up bowing out of the game much earlier than they could have. And it's risk and leverage. Leverage has a way of catching people out, and risk ultimately catches up with them. As a wise older trader once said to me early in my career, he said, Jason, if you want to get rich slowly. And I can tell you, he was right. The people I know in the market who have made a lot of money, they got there slowly. They didn't get there by going all in a triple leveraged fund and trying to shoot the lights out in a couple of weeks. So let's leave that as a wrap for today. Come over and visit me at Motion Trade if you haven't already. Please give me a like, give me a comment, please subscribe, all that stuff. I look forward to coming back, talking to you next week. Until then, bye for now.